Today's financial landscape is charged with dynamic shifts and unexpected turns, leaving investors worldwide on edge. The markets reacted sharply to unfolding global events, signaling a new wave of volatility that demands careful attention. Equity indices experienced notable drops in the opening hours, reflecting deep-rooted concerns about geopolitical tensions and economic slowdowns. Investors are navigating a complex maze of inflation pressures, central bank policies, and supply chain disruptions, each factor exerting profound influence on asset valuations. This high-stakes environment underscores the importance of strategic decision-making and resilience, especially for those looking to safeguard and grow their portfolios amid uncertainty. In the cryptocurrency sector, turmoil has once again taken center stage. Bitcoin's value fluctuated wildly, dipping below a critical threshold before rebounding marginally by the afternoon. Regulatory developments in major economies have intensified scrutiny on digital assets, creating waves of sell-offs and liquidations. Altcoins followed suit, with Ethereum and emerging tokens also suffering steep declines. Market participants are increasingly cautious, recalibrating risk models and focusing on liquidity amid growing fears of an extended crypto winter. This volatility highlights the sector's ongoing maturation pains and the urgent need for clearer frameworks to foster sustainable growth. Commodities markets presented a mixed picture today. Gold prices climbed steadily as safe haven demand surged amidst growing economic uncertainty, offering a reprieve for risk-averse investors. Conversely, crude oil experienced downward pressure influenced by revised global demand forecasts and concerns over recession risks in major economies. OPEC's decision to maintain current production levels has further complicated the supply-demand balance, keeping traders on edge. Meanwhile, industrial metals such as copper and nickel reflected broader manufacturing slowdowns, signaling potential challenges ahead for global economic expansion. These contrasting trends emphasize the delicate balancing act faced by commodity traders navigating a turbulent macroeconomic backdrop. Treasury yields surged noticeably, reflecting shifts in inflation expectations and central bank communications. The U.S. 10-year note surpassed recent highs, triggering adjustments across fixed income portfolios. Higher yields translate into increased borrowing costs for businesses and consumers alike, casting a shadow over corporate earnings forecasts and consumer spending patterns. The Federal Reserve's stance remains pivotal, with markets closely watching signals regarding the pace and scale of future rate hikes. In this high-pressure setting, investors are tasked with managing duration risks while seeking opportunities in a landscape marked by rising interest rates and economic uncertainty.
The technology sector encountered headwinds as shares of major players faced sell-offs amid broader market volatility. Concerns over supply chain disruptions, regulatory hurdles, and potential slowdown in consumer demand weighed heavily. Semiconductor firms reported mixed earnings, with some highlighting ongoing chip shortages, while others voiced caution over future growth prospects. Meanwhile, AI-related companies attracted attention with both optimism and skepticism as investors debated the timing and profitability of next-generation technologies. This sector's performance serves as a bellwether for market sentiment, revealing the tightrope companies must walk between innovation and external pressures. European markets mirrored the global jitters, registering notable declines across key indices. The Eurozone faces mounting inflationary pressures, coupled with slowing industrial output, fueling recession fears. Policymakers grapple with the challenge of balancing rate hikes against economic growth concerns. Bond markets reflected these dynamics, with yields climbing and spreads widening, particularly in peripheral economies. Investors are monitoring political developments and energy supply issues closely, as these factors could significantly influence Europe's economic trajectory. The unfolding situation calls for cautious optimism underpinned by vigilant risk management. In Asia, markets were rattled by developments in the real estate sector and export controls. China's property market instability deepened, with key developers struggling to meet debt obligations, raising contagion risks. Japan's industrial production data disappointed, adding to regional growth concerns. South Korea faced export restrictions impacting semiconductor manufacturing equipment, further exacerbating supply chain disruptions. These regional factors contribute to an environment of uncertainty, compelling investors to reassess exposure to Asian equities and adjust strategies accordingly. The interconnectedness of these economies underscores the global ripple effects of local challenges. Currency markets reacted dynamically to the shifting economic landscape. The U.S. dollar strengthened notably against major currencies, reflecting its status as a safe haven amid global instability. The Japanese yen weakened considerably, prompting speculation about possible interventions by the Bank of Japan. The euro struggled against the dollar, pressured by disappointing economic data and divergent monetary policies. Emerging market currencies faced volatility, influenced by capital outflows and commodity price fluctuations. These currency movements are critical for multinational businesses and investors with global portfolios, affecting trade balances and profit margins. Consumer confidence indicators revealed a sharp decline, signaling rising worries among households about economic prospects. Higher inflation and interest rates are squeezing disposable incomes, dampening spending intentions. Retailers brace for subdued demand during upcoming quarters with early signs of inventory buildups and discounting strategies. Employment data remain mixed, with some sectors experiencing layoffs while others face labor shortages, adding complexity to the economic outlook. Understanding these consumer dynamics is vital for businesses and investors aiming to anticipate market trends and align strategies with evolving demand patterns. Corporate earnings reports continued to provide mixed signals. While some financial institutions beat expectations on net interest margins, others disclosed elevated loan loss provisions, reflecting growing credit risks. Tech giants posted cautious forecasts, emphasizing cost controls amid uncertain consumer and enterprise spending. Energy companies benefited from higher commodity prices but face operational challenges related to geopolitical tensions and regulatory pressures. These earnings narratives offer insights into sector-specific risks and opportunities, guiding investor positioning in a volatile environment. Geopolitical tensions added layers of complexity to market sentiment. Incidents in key global choke points raised fears of supply chain disruptions, particularly in energy markets. Diplomatic efforts to de-escalate conflicts remain ongoing but uncertain, maintaining a risk premium on assets sensitive to geopolitical events. Traders are factoring in these risks, adjusting portfolios to mitigate potential shocks. The intersection of geopolitics and economics continues to shape the investment landscape, requiring vigilant monitoring and adaptive strategies. In Latin America, currency crises and inflationary pressures persist, challenging economic stability. Central banks are responding with aggressive monetary tightening to curb runaway inflation, impacting growth prospects. Argentina's ongoing debt negotiations with international creditors remain a focal point, influencing investor sentiment regionally. Commodity exporters in the region face mixed fortunes as global demand patterns shift. These developments highlight the fragile balance between stabilization efforts and growth imperatives in emerging markets. Venture capital activity slowed markedly, reflecting heightened caution among investors. Funding rounds shrank in size and frequency, particularly in high-risk sectors such as biotech and fintech. Startups are prioritizing operational efficiency and clear paths to profitability to attract capital. The cooling investment climate underscores broader market apprehensions and the recalibration of risk appetites. Entrepreneurs and investors alike must navigate this landscape with strategic foresight and disciplined execution. The real estate sector in developed markets showed signs of further cooling. Housing starts to decline, and mortgage rates remain elevated, discouraging new buyers. Existing home sales dropped, influenced by affordability constraints and economic uncertainty. Builders are adapting with incentives and targeted marketing to sustain demand. These trends suggest a potential rebalancing in housing markets, with implications for construction, finance, and consumer spending sectors. Social media platforms face scrutiny following whistleblower allegations and advertiser backlash. Issues around content moderation, data privacy, and ad fraud have emerged prominently. This has led to stock price volatility and a reevaluation of business models. Brands are exploring alternative advertising channels, including AI-driven personalization and emerging platforms. The evolving digital advertising ecosystem presents both challenges and opportunities for investors and marketers. Artificial intelligence remains a focal point within the tech sector. Despite market volatility, AI companies continue to attract funding and strategic interest. Regulatory and ethical debates are intensifying, shaping the sector's trajectory. Monetization challenges persist, but innovation drives optimism. The unfolding AI landscape represents a transformative frontier with broad implications across industries. Investor sentiment shows increased risk aversion, with flows shifting towards safe haven assets and cash equivalents. Hedge funds and institutional players are recalibrating strategies to navigate uncertain macroeconomic conditions. Market volatility indices have surged, reflecting heightened anxiety. These dynamics underscore the importance of portfolio diversification and risk management in current times. Washington's political environment contributes to market uncertainty, with stalled budget negotiations raising the prospect of a government shutdown.
Potential disruptions to federal operations and delayed economic data releases pose risks to market stability. Investors are factoring in these political risks as part of broader assessments of the U.S. economic outlook. The resolution of these issues will be closely watched for its impact on confidence in financial markets. Energy market volatility continues, influenced by supply chain concerns and geopolitical developments. Prices remain sensitive to OPEC decisions, weather events, and global demand fluctuations. These factors affect inflation trends and economic growth prospects, making energy a critical sector to monitor. Market participants must stay alert to rapidly changing conditions and adapt strategies accordingly. As we conclude today's market overview, the prevailing message is clear. Adaptability and vigilance are essential. With multiple crosscurrents impacting economies and financial markets, staying informed and responsive is key to navigating uncertainty successfully. Whether you're an active trader, long-term investor, or simply managing personal finances, this environment demands a proactive approach. Remember, the ability to anticipate and react swiftly to changes can turn challenges into opportunities. Stay connected, stay sharp, and keep your financial goals firmly in sight.